All right. Well, welcome everyone. My name is Scott Thompson, Senior Manager here at Schwab Coaching, and welcome to Stock Investing for Beginners. Great to see so many of you there, Ray and Eva and Jay Richardson and Kevin and everybody else, Sharon, Ram, good to see you guys. Brett Crowther's in the chat there helping us out. You can follow me and Brett on x.com at Scott Thompson CS or Brett Crowther CS. Great place to stay in touch with what's going on in the marketplace. Our topic today, I've promised for a few weeks now that we're going to delve into or start doing some fundamental analysis. So today we're going to do that. And here's the question. Have you ever wondered if the stock that you're buying or that you're about to buy or that you're thinking about buying is on sale or not? Well, today we're going to introduce a tool to help you determine, at least in some part, a way to, get an idea of what the stock intrinsic value is what they call it. Some people might call it a fair market value, but there's lots of different terms. I think of it in layman's term as just, is this stock on sale or do I have to pay a premium for it? So we'll take a look at that today, go through the steps. There's links already in the description that you can use for the different pages we're going to be using on schwab.com today. But before we go into there, let me share some important information with you. The topic we talk about today, as always, is for general informational purposes only, not a recommendation of any particular investment strategy or stock or individual equity that we look at. Remember that we're using paper money, and there are some significant differences between paper money and the real money account. There's risk associated with investing, that possible to lose that capital. So be aware of that. And then past performance, which is partly tied to the calculator we're going to be using today. Past performance does not guarantee future results. So let's jump over here first to our schwab.com page. And the very, very first place I want to go is show you a resource. You may not be aware of this, but you can go to the schwab.com after you log in and come over to where it says learn. And then we have, of course, the Schwab coaching page over here. But over here we have courses. And if you click on courses, that'll take you to this page. And we have a variety of different courses. Here at the top, Simple Steps to Retirement Portfolio. And then we have Stock Investing with Fundamental Analysis. This is the one I want to have you click on today because the tool that we're going to use here is available for you to download on this page. So I'm going to click this in here. Let me grab this URL for this particular page and I'll chat that in for you there. And this is our stock fundamental analysis course. It's a very detailed course. If you haven't been through it, I would recommend that you go through it. But we're just going to jump down here to the bottom, and there's a couple good resources. One, there's a sample investing plan for a value approach to buying stocks. And here's that intrinsic value calculator. And if you click on the download, it'll download, and then you can pull it up on your page. Now, what it looks like, let me just show you that here. Is this, and we need to do a couple things here on the calculator first. The calculator itself is for educational purposes. The calculations are not guaranteed and they're subject to change, so be aware of that. There's a term in here called margin of safety. That refers to the price difference between the intrinsic value calculation and the securities market price. So it doesn't mean that that should be the floor, that it won't go any lower than that. It's just a calculation. All right. And we're going to come back to this here in just a minute. All right. Now, before we go to the calculator and this idea of, evaluating a stock, I want to give you some background, just a little bit on what this calculator tries to do. Some of the terms you may hear are like discounted cash flow analysis, which I think is a real fancy way to say how much is the stock worth right now. And so the way this works, and let me just go through a really quick exercise here. If you have some questions, feel free to chat those in. Brett does a fantastic job of answering those questions. And then I'll go back through, and like you've seen, I don't know if you've gone back and seen the other videos that we've done or the other webcast. Usually what I'll do is I'll type in the questions in the comment section and answer those questions. So if you want to go back and read those, you can. And I'd love to hear, as you do that, if those are helpful for you. All right. But let's go through this real quickly here. Try to keep this as stock investing for beginners as possible. But let's just say we're trying to calculate the value of a stock. Now, my son a few weeks ago wanted to buy a new car. They're going to have a baby in December. We're very excited about this. It's another grandbaby for me, and so they need a bigger car. So they went out and found a car, and he called me and said, "Hey, this car's trading, or not trading. They're selling this car for 15 grand. Obviously, a used car." Nothing new costs 15 grand anymore, but they were looking at that. And very first thing I asked myself, well, is that a good deal? I didn't know. So the internet has a lot of different tools, and basically, you go there, you find something that does a used car calculator, and you have to put in the make and the model and the year and the mileage, and then it has all the bells and whistles, and they want you to plug all that information in. This calculator that we're doing is very similar to that, where we're going to be plugging in some information, but ultimately the goal is just to come up with a price today based on kind of future earnings projections. So let me give just a really quick example here. Earnings per share. Now, I have some definitions that I want to just, verbally state so you can kind of have these. You probably know what these are, but let me just share these with you anyway. So earnings per share is just a metric that tells, how much the profit the company generates for each outstanding share of the stock. You can go on the internet and Google all these different definitions. The earnings per share growth rate is just simply how fast are those earnings per share growing. In our very first episode 1 that we did on the 9th of January, we talked about why people invest. People invest in stocks because they think the market, the stock or the company is going to grow. And one way to track that growth is that earning per share. They might start off at some number, and then there's this projected growth rate over time. And in our example here, we're just going to use 10%, real simple example. So we're saying 10% is our projected growth rate. If the earnings per share right now are $1, so what would be, now you guys help me out here in the chat, what would be the earnings per share next year? If we projected 10% growth, what would be that earnings per share next year, that first year? You guys chat that in for me, okay? Over here, it would be like $1.10, right? And if we did that again, if that grows, now, I know it's pretty early in the morning for math, but, if it grows by 10% again, what's our year 2 number? What's our year 2 number? You guys chat that in, okay? So if your math is the same as my math, which apparently that's not always the case, year 2, we'd have $1.21 would be our earnings per share, growing 10%. Now, you guys help me out again. Here in this earnings per share on the 3rd year, what would that be? What do you guys have? So $1.33, okay? And we could continue that out for years and years and years. And what the calculator tries to do, and when any time we're doing a discounted cash flow model, is we're trying to figure out, like, if the earnings per share are growing over time and the stock has a value out in the future, how much is that stock worth today? Okay. And so we're going to introduce another term called PE ratio. What's that? Price to earnings. That's basically how much are investors willing to pay, for each dollar of earnings is one way to think of it. There's more sophisticated types of ways, but let's just say, okay, let's assume that the stock we're looking at has a PE ratio of 20. All right. Now you guys help me out with the math. If the PE ratio is 20 and the earnings per share are $1.33, how much would the stock price be? Now, again, this is kind of just arbitrary numbers here. And we just simply take 20. Okay, so let me pull up my calculator here. If we take 20 times the $1.33, then our stock price would be about $26.60. Okay, did everybody see that? So this is, and that's in 3 years. Okay, remember, this is important that you get that. 3 years from now, the stock would be worth $26.60 based on these really simple parameters. So what we're trying to do is, well, how much are we willing to pay for that today? Okay, if we go back till today, I don't want to pay $26.60 for it. I want to pay less, because if I put $26.60 in there, my money has potential to grow in different investments, different opportunities, right? So we're going to discount this price back to today's value, okay? And that's where you kind of get this discounted cash flow model. And again, there's other ways to do this, but this is how we do this. Now, I want to go, before we take a look at the calculator itself, let me pull up the calculator, and we're going to go in here, and there's lots of different things. We have our EPS growth rate. We have the PE ratio for the sector. We have what's called the stock's beta. This is how much the stock moves kind of compared to the S&P 500. We have the expected stock market return. We have the 10-year Treasury index. All of these little boxes are like the bells and whistles when you're trying to figure out the value of the used car that you're going to buy. You know, does it have DVD player? Does it have auto, cruise control, a tow package, whatever's there, right? So these are all those little boxes, the little details that people use to help calculate the value. I'll show you where to find all these things. It's really kind of cool where it is. And if you noticed over here on the right, we're not going to spend a lot of time over here. I'm just going to show you, but all the pages that you need are listed over here in the instructions in the calculator. And then there at the very bottom, we have the stock's current price, the stock's earnings per share current, TTM stands for trailing 12 months, and then the years of projected growth. Now, I'm going to go ahead and fill out the years of projected growth first. And I like to use a small number here. This is kind of like trying to forecast the weather. So the longer we go out, the less accurate this will be. And like I said, none of these things are guaranteed for accuracy, and they're going to be subject to change. But most people, when they use this calculator, like to just use a 2 for years of projected growth. Okay. All right. Now let's take a look here. Let's go over to our Thinkorswim page. And I want to cover a few things. Number one is we got stopped out of a stock during the week. And if we have time, I'll go through that with everybody and review our open positions and so on. But the very most important thing for today is to go through this introduction, and maybe it's a dive in the deep end, depending on how you feel about this, but doing some fundamental analysis on a stock. And in this case, we're just going to determine the intrinsic value of a stock that has a buy signal based on the rules that we've talked about, right? So in our plan, we've talked about if the moving average is rising, okay, so today the moving average value. So again, help me out here. You guys need to know how to find this stuff. But like if I have my cursor, let me put a little line there so we can see it maybe a little easier. If I put my cursor on today, does everybody see the moving average value? It's just right up there, almost right in line with that line. So today the moving average value is at 132.38. And then what we're trying to determine is, do we have a green arrow on the moving average, which we do. We got a green arrow on the moving average. That just means the price is above that 50-period moving average. Do we have a green arrow on the MACD? We do. It got that when it gapped up on earnings. Okay. And do we still have a green arrow? Well, we still have a green arrow today. The green arrow is still green. How long are the arrows green? Again, these are just questions that you need to be able to answer. How long are the green arrows green? They're green until they turn red. Okay. Now, our buy signal is based on the stock having a rising moving average. So if the moving average is rising, then we would have 2 green arrows and a valid buy signal. All right. Now, again, the value of that moving average today is at 132.38. And then yesterday, we just needed to be lower than that to show that it's still rising. Okay. So yesterday, the moving average value was where? Do you guys see that? Look straight up there, right to the right of the vertical line, and the moving average value is at 132.20. So if we take a look at today, 132.38, that's higher than 132.20. We have all the conditions that we need to say this is a valid buy signal. And up until today, we've just acted on these, right? We've built a portfolio of 20 different stocks. We're investing. This is kind of our sample plan number 2. This is sample plan number 3. In episode 3, if you want to go back and watch the recording, in episode 3 is when we actually covered the rules of the plan. But we're investing up to $500 per trade in a mock $10,000 portfolio, about 5% of our portfolio. We're also doing a risk per share methodology where we're risking about $50. So I'll walk through that here in a minute after we do the evaluation. Okay, so we have a buy signal on Pepsi based on our sample plan, not a recommendation. And now we're going to take a look and say, okay, well, is this price at a discount or is it at a little bit of a premium? Do I have to pay a little bit more for the stock? Now, before we get into this analysis here, let me just ask you to type in your answer. Do you think that Pepsi's trading after a big old gap up on earnings? Do you think it's trading at a premium, meaning a little bit higher than what this calculator is going to kick out as the intrinsic value? Or do you think it's going to be trading at a discount, which means it'll be a little bit less than the intrinsic value? And there's not necessarily one way or another that's good or bad. It's just giving you an answer. Just like my son, when I did the research on the car that he was looking at, they were really asking a premium for it, and he decided not to buy it. And he went to another dealer and got a better car, newer car for $3,000 less. And that ended up being a much better deal. Okay, so let's go through this together. And again, I'm just going to show you, I'll talk through where to get these links. Again, the links for the pages that you'll need are already in the description below in the webcast that we're doing right now. But let's type in our symbol. This is PEP. All right, and the first thing we need to go is earnings per share growth rate. Okay, now where do we go to get that? Okay, let's go back to our Schwab page and I'll show you how to do this. So on the Schwab page, it says go to stocks, research. So if you click on research over here on the menu and then just click on stocks, this page will come up. And you'll have research tools, you'll have stocks, there's a whole bunch of other ones up there as well. And what the calculator asks you to do is just go to this stock compare page. So if you click stock compare, it'll bring up, this tool, hopefully. Now let me jump over here. I already did it. So it's trying to load this page for some reason here. But so this page, when you type in the click on stock compare, you're going to type in the symbol of the stock that you want. And we want to scroll down. And what we're looking for is the earnings per share. Or sorry, we're looking for, yeah, that was it, earnings per share. So it's just right here in the valuation section, and it's 5.49. Does everybody see that? 5.49. And I do see a question about the MACD. My MACD settings are 817.9, and that's a little faster than the default, which is 1226.9. All right. But for the tool we're using, again, go to research, stocks, pull up the stock compare page and type in PEP, and then scroll down, and the first component in our calculator is earnings per share growth rate. Okay. And what time frame do we want? Well, we want the earnings per share growth rate to be 5 years. Okay. Now, to get the earnings per share growth rate, we have earnings per share on the stock summary page that I just showed you. All right, which is right here, the earnings per share. We're going to use that a little bit later. And the growth rate is actually on a different page. So let me show you where that is. So we're going to leave this one here. And if you go to like on any stock page and you type in the symbol, like right here, you can type in Pepsi. That'll bring up your page here. And this is active during the day. It's giving you data right now. And the earnings per share, if we scroll down, the earnings per share growth rate, I'm sorry, I'm having trouble finding this here. All right, here it is. I apologize. So this was, let me type this symbol or this link in for you. So this is the earnings per share. This is the first component, earning per share growth rate. So we're going to go 5 years out. That's right here. And the earnings per share growth rate is 6.01. So let's go to our calculator and put that number in. And so one of the things this calculator will do is it kind of discounts whatever. If it's a really high number, it discounts that amount by a higher percentage. But in this case, we're just knocking a 5% off, and it gives us a number, 5.7, that it's going to use to calculate the value of this particular stock. All right. Now, we want to know, is this EPS growth rate and its earnings per share, which we looked at a minute ago, how do those compare to the sector PE, the sector's PE ratio, the price to earnings ratio on the sector? Well, let's go back and find where that is. Again, this is going to be on that stock compare. Okay, so we're on the stock compare page, but what we want to do is up here at the top on the stock compare, that's still loading. I'm glad I put these in earlier. So on the stock compare page, you see where it says index comparison? If you click on that, that will give you a page, and I think it's right here, that has the sector. Now, Pepsi is a consumer staple stock. It's in the consumer staple sector. And so in order to get that intrinsic value of Pepsi, we need to have the sector PE, which is right here. This is your price to earnings ratio on the sector. Okay. And so we're going to take 28.51 and we're going to plug that into our calculator for the sector PE. And again, it's going to do the same thing. It's going to reduce this or discount it a little bit just based on lots of research. They try to get a fair value for these different numbers that we're putting in. Okay, so we had 28.51. So we're going to put that in, and it discounted it by about 15%. So it's kind of using a PE ratio of 24.2. Okay. Again, over here on the directions, you can see where to go to get these pages. And for some reason, my pages aren't loading up. So, thankfully, I loaded these in prior, so we have the data. All right. Now, CAPM, what does CAPM stand for? Well, CAPM stands for Capital Asset Pricing Model. Okay. That sounds, for someone who's new, that's probably blah, blah, blah. Ginger, if you've seen Farside, it's just a model. It helps investors understand the difference between the risk and the expected return, and they use a few components. The stock's beta. Now, I talked about this a little bit earlier, but the stock's beta, again, all of where you need to go is right here, but the stock's beta is on that summary page. Let me show you what that looks like. So when you type in Pepsi, okay, like on the stock summary page, if you type in Pepsi in the symbol box, you can see the current price right here, 140.89. I'm going to write that down because we need that in a minute. 140.89 is our current price, but the beta is on this page down in the technical section, which is down the bottom. And if you go here, it says the stock's beta is 0.46. So we're going to take this value and type it into the model or the calculator. All right, so let's go back over to the calculator and we're going to type in 0.46. Oops, not 0.046. So 0.46. Now, expected stock market return. Now, Charles Schwab is a very conservative company. There's a link that I've posted. Again, it's already in the chat at the very top of the chat page. But here's the URL, schwab.com, learn story, Schwab's long-term capital market expectations. And this is the page that will come up when you go there. And again, I'll chat this link into the chat so you have it here. All right, so there's the link for this page. But on this page, Schwab's 2025 long-term capital market expectations, they do this every year. If you scroll down, and many of you will be surprised at how low this is, but the expected returns over the next 10 years for large cap equities is right there. The light blue is where we're looking, and it's 6%, okay? Now, we're going to use this number here, but I do want to say over the last 5 years now, the S&P has returned about 13.6%, and over the last 10 years, it's been 12.5%. And when we're done with this analysis, I'll show you how changing that expected market return will change the calculator, and we can do that together, okay? So on this here, we're going to use 6% in our model. All right. So 6% expected market return. And then the 10-year treasury. Now, again, the 10-year treasury is on the stock, the research page. And again, my pages weren't loading. So let me see if I can pull this up. Hopefully this will load for me. I've got the data written down if it does not. But on the stocks page, if you go to research and, it's research and then US markets and the indices page will come up. Just scroll down a little bit to where it says show more. Okay, and this one's not loading for me either. But what you want to do is go down on this page, and I don't know why it's not loading, but on this page, there's a bunch of data that comes up. About 2/3 of the page down, there's a link for or a number for the 10-year treasury. And when I checked it this morning, that number was at 44.32. Okay. Now, I apologize again, the technology is not helping me out very much here. But let me show you how to use the calculator. Now, on the 10-year treasury, again, this morning when I pulled that page up, it's not loading right now, so I apologize for that. But the number was 44.32. Now, 44% obviously not the 10-year treasury, but it is the 10-year treasury index. And what we use is enter the index value, it says here in the calculator. So we're going to put that 44.32 in here, and then it says the risk-free rate is about 4.4%. Okay, so this capital appreciation model here is using the stock's beta, the expected market return, and that 10-year treasury to get an idea of, what your risk-free money's worth. And they're taking that calculation here to calculate now the value of the stock. All right. Now, the last little piece here, we had stock price. Okay. And I wrote that down earlier. We're going to put 140.89. That's the current price. I know it's changing. The market's open. And does anybody remember that stock earnings per share? Again, this is on that research page, stock page that isn't loading for us. But again, I wrote these down before we started. Let me see if I can get that page to come up. Oh, so here's the stock comparison page where you can get the earnings. You scroll down, earnings per share is 5.49 on Pepsi. So that's the number we're going to plug in here for this calculator. Okay. And so let's go to our calculator and put that number in there. And then it'll kick out. It'll take all these information that we've put in, just like when you're doing searching for your used car. Once you hit all the data and hit calculate, it kicks back a number. Now, the intrinsic value, the number that's going to show up right here, is what the stock, intrinsic value is. Again, that's just an arbitrary number that says, based on this model, this is what the stock should be trading for. Then it will take a look at the stock price and compare those two. And if there's what's called a margin of safety, it'll be a positive number. It'll say 10% less than the intrinsic value. If the stock isn't on sale, let's say, and the market right now is asking a premium, and I asked you earlier, what was your forecast? Did you think Pepsi, after gapping up on earnings and even pulling back a little bit, do you think this is going to be on sale, or do you think this is going to be trading at a little bit of a premium where it's gapped up and it's pulled back a little bit? So again, if you haven't guessed that already, let's see. So our stock earnings per share, we said, was 5.49. And when I hit enter, it should kick back a number for us. All right. So here's how this works. All right. Intrinsic value, based on the numbers that we've put in there, that intrinsic value should be about $134.45. And right now the stock is trading at 140.89. So the question then is the stock on sale? Is the stock trading at a discount? Can we buy it at a discount right now? And the answer, apparently, based on the calculator, again, and there's no guarantee here on these numbers. It's just using a calculator, just like the one on the internet for a used car, just gives us an idea. And right now it looks like the stock's trading at a little bit of a premium. And so now we have to decide, do I want to go ahead and buy this stock? And some investors might say, you know what, I'm not going to buy that. But let me give you a little caveat right here. And I think, from our analysis, and I apologize again that the pages haven't really been loading right. I don't have time to go through this again, but there's a couple really good videos on using this calculator, and Brent Moores did one not too long. Well, it was a little bit ago, but he went through how to do this and fill it out, and the pages were loading for him during the presentation. So if you want to go back and check that out, you can do that. But here's the deal, okay? There's a couple different methods of investing. One is called value investing. Value investors try to buy stocks that are undervalued or on sale, and kind of buy those and hold them until maybe they get up to that par value or they get up to that intrinsic value idea. That's called value investing. This method that we're using for our sample plan, where we're waiting for the stock to get above a rising moving average and we're waiting for some momentum before we actually purchase the stock, and the investing plan is more what's called a growth model. When we're buying stocks that are already trending up, that have not been beaten down in price and that are trending back up, those are typically going to be trading at a little bit of a premium, and the margin of safety, like we see here, is going to be a little bit more negative. And then you'll just have to decide, how much margin of safety or above margin of safety do you want to go? Is it a valid buy signal or not? Okay. Now, I know there's a lot of questions in here. It's an estimate. So let's go back now to our Thinkorswim page, and we can decide for ourselves whether or not we want to buy the stock. Okay. So we have a buy signal. We have our moving average rising. The stock gapped up on earnings and it's starting to pull back a little bit. We don't have to pay $145 for it on the gap up day. When I saw this, I thought, well, I want to talk about this on Monday in our class also. So here, let me give you some little technical analysis nuggets here. All right. Number one, when the stock gaps up, what would you do? Let's say you're the investor that bought this stock back a month and a half, 2-3 months ago, when it was trading around 145. And shortly after you got in, the stock dropped on earnings and went all the way down to 127. What are you hoping happens? Aren't you just hoping and praying the stock gets back up to 140, 145 so that you can do what? What would you do? Let's say you're this investor and you've been riding this thing for 3 months and it's finally back up to where you got it. Well, a lot of investors, what they tend to do is they just hope and pray that it gets back up to that price they bought it for so they can sell it and get out break even, okay? And this is pretty common when we see something gap up, especially after being sold off a little bit. Investor psychology basically indicates, hey, there might be some profit taking. So it's very common when the stock gaps up to see a little bit of a pullback. Now, let me give you some technical indicator idea or technical analysis ideas. Okay, the low, the very first place that technical traders are going to look for to hold as support is the low of that gap up day. Okay, the low of that gap up day was 141.64. Obviously, we're trading a little bit below that right now. Now, we don't know where this is going to close at the end of the day today, but we do know that that's the first area. And there, we've been sold down through that right now. We could see a rally back up and close back above that level, but that's the first level of technical support that traders will look for and investors. So I'm going to go ahead and draw a line at that area, just visually so we have it. Okay, that's 141.64. The next area that's pretty common, now this one's not maybe as well known as some of the others, is the midway point through the difference between previous resistance and that low of the gap day. So the midway point, I'm just going to guesstimate, it's right about here, about 139, let's call it. This is another area that is very common for traders to watch as far as it might come down and sell off there. And then, of course, we have the old resistance. Old resistance may become new support. We know that one. So those are some areas that we might watch. So what could we do? Could we do this a couple different ways? Now, I'm going to go through our plan and just go ahead and make this purchase for our example. Again, not a recommendation here because we still have the 3 green arrows. The moving average is still rising. We're going to buy the shares up here about 140.88. The rules say to set our stop 1% below the moving average. That's just this rule that we've set up for our plan. You can determine your own plan. But the moving average we see is where? 132.38. So if I pull up my calculator, 132.38 times 0.99, our stop would be about 131.05. So I'm going to write that number down just so I have it, 131.05. And then how many shares can we buy? Well, the easiest way to do this one, just because it's $140 stock, is let's just take the $500 that we're willing to invest in any single position divided by that 140.90-ish. And we can do 3 shares. Okay, so that's what we're going to do. And we're going to set up our stop at 131.05 at the same time. All right, so we'll go to the trade page. We're going to type in PEP, and we're going to do a right click on the ask price. We're going to do a buy custom with a stop because we're going to set up our stop order at the same time. We're going to do 3 shares. So I'm going to bump that up to 3. We're going to lock this link together right here. And that way the number of shares that we're buying is going to be the same as the number we're selling. And we're going to come over here with our price, and we'll just make it a market order right now so the order fills and we don't have to wait for that while we're in class here. And our stop, we said, was going to be 131.05. And what do we need to do here on the stop order? The default setting generally is a day order, so we want that to be good till canceled. So hit that drop-down menu and then click GTC, that stands for good till canceled. And then we hit confirm and send, and now we want to review the order. You know, we want to double check our investment total. Looks like we're going to be about 422.49. You know, we're setting a stop order at 131.05. Now, if there's some red lines down here, you want to read those. With stop orders, no guarantee that execution price will be equal to or near the activation price. We know that if it gaps over, it'll sell it for us, so whatever that available price is. And we're going to put this in our 2 green arrow position here and click send. And that should fill for us. Now, here we are on the monitor tab. We just bought Pepsi, and I'm going to go ahead and add that to our list. This is our list of stocks that we've been trading. Abbott we got stopped out of this week. AT&T we got stopped out of a little bit before. And we only have about 3 or 4 minutes left. So what I want to do real quickly is just go through and show you some different things. I recognize there's a bunch of questions in the chat. And like I said, there are a bunch of links in the description. Brett's been doing a great job answering the questions. I will also go back in, and on the recording of this particular webcast, I'll go in and answer those questions that Brett maybe couldn't get to today in the comments section. So go back and check those out when the recording gets posted. It should be posted in about an hour, 2 hours after we finish. All right, but so here we go. Here's the positions that we have all here. I want to go over to the chart and take a quick look at Abbott. Okay, and again, just real quickly, Abbott, did we have a valid buy signal? Okay, MACD and the moving average were green. We just broke resistance. That was a valid entry point. It just didn't work. Well, welcome to the market. Sometimes that'll happen. We got 3 red arrows right here. Okay, the rule says, 2 red arrows. When the stock closes below the moving average, usually the MACD is going to be red already, and then the stock closes below the moving average. The rule is to put the stop 3% below the low price that day, trying to give it some wiggle room, a chance to recover. But in this particular case, the low was at 131.47, and our stop would have been lower than our original stop. So what's the rule there? Well, we never lower that original stop. We let the original stop do its job, which is get us out of the trade if it keeps going down, which it did. We got stopped out on the 15th, and then on earnings, it gapped over. Now, I have seen a number of questions about this particular plan. Do we hold over earnings? The answer to that is yes. This is a longer-term investing plan. We hope to buy these and hold them for 16 years or more. We just want them to keep trending up. That maybe not happen, but sometimes we'll get it on a valid entry and it just doesn't work and we get stopped out and we had a small loss. Here's the details on that particular trade. Our original stop was at 130.95. We got filled at 130.94, so a penny less here in paper money. And then it gapped down, and we're thankful that we're not in the trade anymore, right? So that's taking a look at that. Now, I won't have time to do all the activities, but for homework, let me give you some activities, okay? So SPG, this is a stock that we bought over here on a little bit of a diagonal breakout. We got 3 red arrows over here on the 15th. And I didn't adjust the stop, but I want to give you kind of an idea. That's our rule to adjust the stop. The low price is 159.33. And so the stop rule is to put the stop 3% below that low price, which I think works out to be about 154.55. And one thing to check, like if a stock has been trading a little bit sideways like SPG has, and it looks like we have some support around that 156 level, again, a general rule that investors and technical traders like to follow is that to keep their stop below that support. If the rule said to put the stop at 157, for example, they might say, you know what, if it goes down to 157 and bounces off that support, I don't really want to be out of the trade. So I'm going to put my stop down below there, and it has to make a new low in the trend before it stops us out, okay? So I'll make that adjustment here in our portfolio. The other thing that's kind of fun is after you buy a stock that does trend up, let me show you a couple of these. You know, we bought Citigroup in our example portfolio here on the buy signal that happened back on the 24th, and the stock's just taken off. This is exactly what we want to have happen, okay? And then people ask, well, when do I get to move my stop up? Well, we get to move our stop up when we get new buy signals, right? So just recently, in fact, 3 days ago, the 17th, the MACD went green again. The stock's still above the moving average. So at this point on the 17th, we could have moved our stop up, okay? So again, for homework, and I'll do these manually on our portfolio here ourselves, but manually the rule says, okay, when we get a new buy signal, we can put the stop 1% below the moving average. And after you've been in a trade for 6, 7, 8, 10 weeks or so, that stop order starts to be above that original purchase price, which is kind of a cool place to be. Now, again, no guarantee that you're going to get filled, you know, at the stop price when on those stop orders, but the point is that after being in a trade for a little while, our stop order starts to be above our purchase price, and potentially we could get stopped out at a price higher and have a decent little gain on the stock, okay? But Citigroup's one that gave a new buy signal. Here's another one that gave a new buy signal, AMD. AMD we bought back here on the 16th. It's been trending up nicely. The MACD gave a new green arrow there on the 15th. And so what's the rule? Well, we got a new green arrow. If I didn't already own the stock, I could buy it there. If I bought it there, where would the stop go? 1% below the moving average. So the moving average value there is 122.69, and we could move our stop up there. And I think this one I did earlier in the week. This one, the stop's at 121.46, okay? So those are the examples that I wanted to cover today. I know that, you know, we had some challenges there with the calculator. Go back and watch the recording there. You know, you can plug the numbers in. One of the things I did want to share with you is, you know, if your expected market return is higher, if I put 10% in here, what do you think is going to happen to the intrinsic value? Well, let's see. You know, the bigger the market returns, the lower that intrinsic value is, because again, it's discounting back in time, and our margin of safety is now not as small, okay? We're paying a much more of a premium for that stock, okay? If the market returns are less, let's say 5%, then we have a little bit better margin of safety. But what did we want to do today? Well, we wanted to go over our webcast. We wanted to share the different things that we can do to determine whether the stock's on sale or not. We wanted to take a look at our existing positions, and we placed a new trade on Pepsi. So hopefully that was helpful for you today. And, you know, go do your homework, and then we'll see you next week. And as promised, on the 28th, next Monday, we'll do an update on our ETF holdings for our example plan number 1. And that'll be kind of toward the end of the session on Monday. We'll do a live only session there. So love to see you there. All right. Well, thanks everybody. Have a great day.